Hi, folks. Dan Bird here with the Daily Scan Midday Update for Friday, August 29th, the last day of August, last day of the month. And it's really odd. There is red on the screen today. You can see the Magnificent Seven going across the top up there. And this is very strange. I mean, I don't know really how to act seeing red. The market doesn't do that. I thought it was only supposed to go up. I'll talk about that in a minute. I'm not a financial planner, so this is for educational purposes only. So let's take a look at what's going on. I've got a very interesting topic to cover today at the end of the session. So let's take a look real quick at what's going on here. 10-minute charts, and you'll see the market is heading lower. How can that be? Actually just came back down to Monday and the previous Monday, so it's really just back to the previous opens for the week. Not too concerning yet, just kind of weird. Money flow is negative, but it's been negative before. So we'll see how that turns out. However, the aggressive sectors, financials is doing really well, but technology, discretionary, communications, and industrials are either down or flat. So they, especially technology, in particular, technology. And then if we look at the defensive sectors, healthcare slightly up, staples is up, energy's up, utilities up a little bit, materials significantly up. So the rotation is clearly moving from aggressive to defensive right now. If we look at the rotation graphs, growth versus value is coming down, discretionary versus staples, technology, semiconductors, internet, everything is coming down, everything that usually pushes the market up. These are all the big stocks that push the market up. And the Russell 2000 also heading lower today, basically just above Monday's open. So that's not really too bad for the week, basically sideways. But large cap, mid cap, and small cap growth versus value, you can see clearly it's out of growth. So the rotation is out of the growth area. And then finally, for the NASDAQ 100, clearly down as well, sitting right on the second support level. So there's the pivot right here. There's the first support, second support. It's sitting right there on that second support. So depending on what happens the rest of the day, well, it'll be interesting to see how this closes out the week. I have a feeling it might actually go lower. But because of sitting on the second support level, that means the market is trying to decide whether to bounce from here and head back up or break through it and head back down. And then we're going to get a whole new set of these for next week. We'll see what that looks like. So anyway, the market is down today. If we look at the dashboard, equities, S&P down, NASDAQ 100 down, the VIX is up to 1537. That's not really a lot. It's really not even back to 17 yet. And bonds, I'm going to talk about bonds here in a minute. 10-year is up. Dollar is down. Commodities, gold is up nicely. Oil is down slightly. And then crypto, of course, Bitcoin, which is highly correlated to the NASDAQ 100, is down just like the NASDAQ is. Looks like Ethereum and Bitcoin are basically running neck and neck. And Solana is, let's see, the one that's down the least is Solana. So it's actually looking the best today. But that's what those look like. So let's go down and look at the sector summary: staples, energy, financials, healthcare, real estate. All five are defensive sectors. At the bottom is industrial, technology, consumer, discretionary, communications. Those are all aggressive. So they're right, very clearly there's the rotation today. And not much breadth, about an equal between advancers and decliners, except for utilities has more advancers and staples. Those are the two, number one and number two, actually, most defensive sectors. So they're actually falling. And then down here, a firm, I think a firm might have reported it's got a black candle, but it had a really big gap up today. Celsius, moving higher today. Looks pretty good. What's over here? Gold, of course, is going up. Solar Edge hanging in there. See what's coming down. Sterling Infrastructure, CLS, which has been a consistent upward mover. Looks like it's got a double top right there. So it's starting to head lower. Oracle, look at Oracle. Look at those 4 big red candles. Oracle is just determined to head lower. AMSC, Creative Technology, looked like it was moving up nicely, starting to come back now. Oscar, someone had asked about, just slightly rolling over. And that's it for those. All right, let me take a look at a stock that somebody wanted me to look at. So let me do that first. I will look at MSB. I don't know anything about this asset manager. So financials have been doing really well. It's right back to the 21. So if you're looking for an entry, this is probably a pretty good place to get in. There's the Keltner channels clearly right in the middle. Still got a red bar, so I'd wait for a green bar before taking a position, but it's sitting right on the 41. So that looks pretty good. And money flow is just starting to move higher down here. Money flow has actually been heading down, but it's not down to the 50% level yet. So overall, looks pretty good. Look at it further back, pretty choppy, but it's had a nice move along with financials and asset managers in particular was the one industry group within financials that had been doing the best. So it looks like it's continuing to head higher, hit basically this double top right here and came right back to the 21. And that's where hopefully it should bounce. But again, I would wait for a green bar for that to happen. All right, let's go back over here and I want to show you the volatility chart that I put together. This basically is the VIX, which is a 1 month, 1 month forward look and a 3 month forward look, VXV. So when VXV is outperforming, meaning 3 months out, the expectation is for higher volatility. And the black one is the VIX, the 1 month. So when you see the black, that means the 1 month is outperforming. If you see the pink, that means the 3 month is outperforming. Right now, the black, meaning it's starting to rotate back into short-term volatility. It's starting to head higher again. This also, the pink line shows you the 3 month, the gray line shows you the 1 month. And when the 1 month crosses over, then usually that's when the market is starting to decline, and maybe even significantly. So nothing too earth-shattering yet, but whenever this gets up here, when it gets to this level over 1.2, and then starts coming down from there, that's usually where you get the tops. It's usually where tops happen. So keep an eye on that. All right, the next thing I want to talk about is comment that I made on the YouTube site yesterday, basically saying that the market will never go down again. And it was fairly tongue-in-cheek. I didn't really mean that, but just seems like it keeps hitting new highs day after day after day, no matter what. No matter whether it's a Fed meeting, it's Jackson Hole, it's a CPI number, PCE, doesn't seem to matter. The market just keeps on going higher. If you look at the market bias matrix, you can see right here, pulled back a little bit and then started to head higher. If we look at the S&P, just nothing but a run higher. Pulling back today, but I mean, it's done that before, so that's not anything earth-shattering. Could easily come back to the 21 and still have the uptrend in place. So the market just continually goes higher. So one of the reasons for that is, first of all, there is no really negative catalyst to speak about right now. Earnings are pretty much over. All the economic data is pretty much in. We've got jobs number coming next week. That could move it, but there isn't really a big catalyst out there, other than September being historically the weakest month, but there can always be an anomaly. We could not pay any attention to that and keep going higher. So in general, the market has continued to go higher. Number two, because the market's been going up, and in fact, if I go back here and look at on the home page, we can look at the current secular bull market. There is the current secular bull market. You can see we just consistently off the 2009 low right here. We can consistently go higher. Sure, we have pullbacks. We had one in 2015. We had one in 2018, the last trade war, tariffs. We had one in 2020, of course, with the pandemic, but never really broke down, continued higher. We had 2022, was the cyclical bear market. And then we had the downtrend in the beginning of this year, right there, but it always comes back and hits these upper lines. So the blue line right here is basically the upper trend line. We broke through it here in 21 when we had a roaring bull market, similar to what we have now. But notice here in 21, that's right after the pandemic. So in 21, it was all buyers. So everyone was getting in the market. Everyone was buying. Everyone was buying the dip. Any small little dip that went down, retail traders were buying it, and it pushed the market up until we got to 22. That's one of the things that's happening now. Retail traders are just pushing it up. Everybody wants to get in. They hear about their neighbors making money in stocks, so they want to get in too. So everybody gets in. Usually that happens at the top, by the way. I also drew a trend line from the top back here in 2008 to the top in 2021. And notice where these both, the gray line and the blue line, notice where they meet. It's basically right now. So we're above that line right now. So number one, it could mean that that's a breakout and we will just continue higher forever. Number two, it could be the point of exhaustion where the market rolls over. All right, so one of the reasons it just keeps going up is because retail traders keep getting in and more of them get in as they continue to make money. The other reason that it goes up is because and I've talked about this before, it's based on primarily the Magnificent Seven or the big cap tech stocks. And those are found in every 401k, every IRA, every ETF that everyone's piling into. So anytime ETFs get bought, these Magnificent Seven get bought. Magnificent Seven and Friends, I'll call it. So I'm going to look at each one of these today, and you'll see what they look like today. But this is the other reason why the market keeps going higher. It's structurally designed to do that. So as more and more companies pile into 401k and IRAs and ETFs, all that money flows to usually the big seven or the top 10 stocks. Very limited. Notice how all that turned red just a second ago. So here's AMD. We'll look at each one of these. AMD right there. Looks like a double top. Here's Google. Google actually looks pretty good. It's the one stock that looks good today. Amazon, big red bar. That could be a bearish engulfing. Of course, it depends on how it ends the day. Apple, actually, Apple's one of the ones that looks pretty good, but it could be getting to a double top. Arista Networks looks okay, but it has a spinning top. Broadcom, big red candle today on Broadcom. Costco, red candle today as well, after hitting a double top right here. Here's Eli Lilly. Eli Lilly actually is hanging in there pretty well. Meta. All of these Magnificent Seven are the ones that ETFs are buying no matter what happens. So that one is sitting right above the 50-day, heading down today. Microsoft was going down, starting to come back a little bit, but just below the 21, sitting right on the 50. So that's a precarious position. Here's NVIDIA, which has been doing nothing but going higher, has a big red candle today. Netflix has a big red candle today. Oracle, big, huge red candle. I showed you this before. Look at that, 4 big red candles in a row. So this is buy the dip. Everyone that wanted to be in Oracle had a big down day, buy the dip. Another big down day, buy the dip. What's going to happen today? Could be more buy the dippers. Palantir, sitting right on the 50-day. Taiwan Semiconductors, big red candle. Tesla, big red candle. None of these have really broken down significantly yet, but they are showing signs. They're showing signs of weakness, and this is what has been keeping the whole market up right here. So is today the day? No way to tell. Next Tuesday is the first trading day of September. September is the weakest month of the year. Who knows? So the next thing I want to talk about is I want to show you a quote. Here's a quote from this guy, Irving Fisher, economics professor at Yale, said stocks have reached what looks like a permanently high plateau. He said that in 1929. We all know what happened in 1929, a big crash. The other thing that I did a little bit of research on today is Japan. Could Japan be the fly in the ointment? Could Japan be the canary in the coal mine? Is Japan the one that's going to start to send everything collapsing? So I saw a note about the Japan carry trade, but also about the 30-year yield that has, for the first time, hit a high. So I put this on the website for subscribers. If you go to the charts page, this is something that you should keep an eye on. Go to the charts page all the way down in the second column, the blue column at the bottom where it says international. Now, Stock Charts did not have a chart for this, so I went to TradingView for this chart. And here is the Japanese 30-year yield, 3.18 right now. Notice it's higher than it has ever been. So Japan has been what they call yield curve control. That's what they've been managing for the last few years. Basically, they were trying to keep rates low so that it would be a very low borrowing rate for their economy that also encouraged the Japanese carry trade. In other words, people would borrow cheaply in Japan, and they would use that money to buy equities or other assets around the world that were priced more expensively. But that carry trade is now pretty much starting to collapse. So what does that mean? Well, what it could mean is that all of those Japanese borrowers are going to start pulling their money back out of equities and bringing them back to Japan because they can get a much better yield. Now, the 30-year yield in Japan is almost 3.2. You can see in the US is 4.93. Great Britain is 5.6. Germany is 3.3. So the Japanese yield is almost equal to Germany, and there is a cost of buying these other bonds, whereas if you keep your money in Japan, you don't have that cost. So that adds another layer of value for people buying the Japanese 30-year. Now, what happens if this continues? What happens if this keeps going up? Well, I asked AI that question, and I posted it right here that you can, at your leisure, if you're a subscriber, at your leisure, you can go through this, but I'll highlight a couple of things. I asked, what if it gets to 4%? Right now it's about 3.2 and going up quickly. So Japanese investors hold trillions in US treasuries. In fact, Japan is the #1 holder of US bonds, US treasuries. China is #2. Actually, the biggest of all of them is the Fed. But out of the global countries, Japan is the #1 holder. All right, so if their 30-year gets to 4%, here is what could happen. Mild shock, S&P 500 could lose 5 to 10% if the rise is gradual and tied to strong Japanese growth. Moderate, 10 to 20% if yields rise abruptly, which is what they have been doing due to inflation or policy error. Policy error could be the canceling of that yield curve control. So Bank of Japan is no longer exercising yield curve control. They're basically allowing the rates to float to their natural level instead of trying to keep them down. Severe shock, more than 20% if it triggers a global bond sell-off, which could happen because all that money right now that's in other global bonds will start to move back into Japan because it's a much more attractive area to be. So unprecedented and likely signal a global repricing of risk. U.S. stocks, especially tech and high duration assets, could face serious headwinds, but the actual decline would hinge on investor psychology. So then I asked historical events similar to this. U.S. debt downgrade 2025, that really didn't have much of an effect. Here's the end of the yield curve control. That's just happened the last year, where Bank of Japan abandoned its strict yield curve control, allowing 10-year Japanese global bonds to rise past 1.5%. That also affects the 30-year, right? So then finally, long-term capital in 1998, where the market crashed based on this one. It was basically an unwinding of the carry trade. That could happen again. So what makes this unique? Unlike past episodes, a 4% yield would reflect a complete reversal of Japan's decades-long ultra-loose monetary policy, signal breakdown in confidence in Japan's fiscal responsibility, sustainability, shift in global capital flows, potential domino effect in global bond markets. And then I asked, how would it affect U.S. stocks? What sectors, U.S. stocks, high duration, high sensitivity. So there would be value compression. Emerging markets would decline, carry trade unwinding, gold, but likely bullish for gold. So it actually might help gold. And then global repricing. So this is the one thing that could start a chain reaction across the globe and really start to play on what happens with U.S. stocks, especially the large cap technology stocks that I just went through. They're the ones that have been holding the market up. And if they start to roll over in any significant way, and this is what could cause that. So right now we're at 3 point. You can see the rate of increase, especially right here. This is from September of 24 until now. That is a very steep, and it's getting steeper. So it keeps on moving higher. So I would encourage you to keep an eye on this chart. If this gets up to 4%, that's what the question that I asked, and that's what all of that that narrative was all about. If it gets to 4%, one thing that you'll notice if you go back a month, you can see that it's starting to decline a little bit from 1 month ago. 5 days ago, it's negative, so it's starting to come down. Here's 6 months ago. 6 months, it's still higher. So just in the last month, it's begun to come down slightly. But if that does not continue, if it starts to go back up again, then you have to be really careful, because this could have a global effect on equities. So not to scare anybody, but I just wanted people to know this. It's something that I saw and I did a little bit of research on, and this is something I think I want to keep an eye on. And one of the reasons I put it on the website, so you can always just come here, read this at your leisure, but you can look at the chart anytime you want. It will update automatically, and you can see the chart of the 30-year Japanese government bond. I suspect I'll be talking with Zuber about this on Sunday. All right, thanks for watching, everyone. We'll see how the day ends. So far, let's see where we are. Still hugging that. By the way, it's still hugging that support line. Let's see if this was Fibonacci level, what it would look like. So yeah, it's sitting right on the 68% Fibonacci. Actually, it's sitting on the 100%. So it's on the last Fibonacci level right there. So it's either going to bounce and come back higher, or it's going to crash through this at some point, probably by the end of the day. So it's important to watch this. Right now it's 11:42 a.m. on the East Coast. And you can see up volume minus down volume is below zero. So it's negative, and advancers and decliners are dropping off a cliff, basically. So keep an eye on it. Here's the Russell 2000 going sideways, S&P going sideways right at Monday's open. So all of this, we'll see what happens at the end, see how the day closes out. All right, I hope this was informative for everyone. Let me know if you have any questions, and like and subscribe so we can keep the channel going if you want me to do that. And I will have a great weekend, long weekend. Can't lose any money on Monday. Markets are closed. So I might do a video Monday, I'm not sure, but definitely on Tuesday. I'll talk to you then. Take care.